Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 9th of January. I'm Daniel Lam, your host for the podcast. Besides the strength in the US dollar, the key indicator in US 10-year government bond yield has also been heading higher. Now, since holding the support just under 4.2% in the middle of December last year, it has been rising since, past the key resistance zone at 4.5%. So many clients, particularly those who are income focused, have been asking, when will the longer dated yields come off? Well, judging from the recent data and macro developments, it is likely to be staying elevated in the very near term. So why is that? Well, first of all, it is only the second week of the new year, but geopolitical tensions have already been running high. You've got the addition of high-profile Chinese companies into the US military blacklist. You got Trump's remarks about Canada, the Panama Canal, and Greenland. All these is adding fuel to the US exceptionalism trade. Investors' perception of the US keeping its growth going at the expense of the rest of the world. However, this is also backed by the latest data releases. So, for example, the US job openings once again beat expectations in November, increasing to 8.1 million from 7.8 million in October. The gap between quits and layoffs, which is a leading indicator of labor market demand, ticked down. The jobs gap, which is the difference between labor demand and supply, remains in the slightly positive territory. So taking all these together, this shows the labor market is cooling down, which is consistent with our view of a soft landing in the US economy. Furthermore, the December ISM Services PMI beat estimates, increasing to 54.1 from 52.1 in November. All these subcomponents increased, except for employment, which nonetheless remains in expansion. So we believe the outperformance of US equities is likely to continue in the very near term. For those interested in fixed income, DM high yield is our preferred area because the likely US soft landing can keep default rates low. The next key data point will be the US non-farm payroll coming out this Friday. A stronger than expected data may well propel the US exceptionalism trades further, probably until the Trump's presidential inauguration. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.